What's up, guys? Welcome back to the channel. Today is episode 90. So today is going to be a short video, but I wanted to talk to you guys about the power of dollar cost averaging and pretty much three ways that we could tackle it. So as you guys see up on the screen here, there's an information card about it, and it just says dollar cost averaging is an investment strategy that aims to apply value investing principles to regular investments. The term was first coined by Benjamin Graham in his book, The Intelligent Investor. Graham writes that dollar cost averaging means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter. In this way, he buys more shares when the market is low than when it is high, and he's likely to end up with a satisfactory overall price for all his holdings. And this is a very simple concept, guys. Yes, the market does dip. If you look at any particular chart, you will notice that the stock goes up and sometimes it goes down. But when you look at the overall trend of the stock, if it's a stock that it's a good stock, the overall trend is always going to be in the up direction. So the whole concept of dollar cost averaging is simply just to buy in at regular intervals, whether the stock is up or down, on the premise that, let's say, if you buy $10 worth of the stock today, in a month from now, or 2 weeks, or maybe even a week from now, that $10 worth is possibly going to be $11 worth. And you will eventually get your overall price at a lower base. And you consistently invest in this asset that you know will eventually go up. Now, some people will say, oh, I want to wait for the pullback. And waiting for the pullback is cool. It's good, but it's not the best strategy, because more times than not, it will be in an upward trend. So it's best to try and catch it at a regular interval, and then you go from there. So pretty much what we're going to take a look at today is just three strategies for dollar cost averaging to make it the most effective. So the first strategy, as you guys can see up on the screen right here, is to buy in at a large amount. Now, some people will tell you, hey, if you're buying at a regular, or let's say you get a windfall of cash and you buy in, that's not the best way to do it. The best way to do it is to buy in at small intervals and wait. No. Like I said before, if you buy in $10 now, then a week or two from now, that $10 will probably be $1 or $12 more, or whatever it is. It'll be increased over time. So if you have a windfall of cash, let's say you get a settlement or you do some type of deal or sale and you get a large amount of cash. Let's say you sell a car and you get a large amount of cash. If you invest in that particular stock at that particular time, then the investment's going to grow, because again, what you're doing is you're using that large amount of cash to capture that price at that point. Now, if it is the dip, it's even better. But if it's not the dip, the current price that it's at right now, if the overall trend of this asset that you're trying to invest in is going up, eventually it's going to go up. So that, let's say you put $5,000 in, that $5,000 in maybe a couple months will now be $5,500. So that's the first strategy. If you have a large amount of cash and you obviously look at the fundamentals of the asset, let's say it's Microsoft or SPY or QQQ, and you decide to buy in, then buying in with a large amount of cash is definitely one of the strategies that you want to do. And that's something that I particularly do myself. All right, so now let's look at the second strategy. So the second strategy is to buy in at regular intervals. And when I say regular intervals, I mean you would go into, say, your Robinhood account, and you would find the asset that you want to invest regularly on. When you scroll down, you're going to see an option that says go ahead and set up regular interval investing or dollar cost averaging. Once you click on that, it's going to ask you for the amount that you want to go ahead and invest. And then it's going to also ask you for the frequency of the investment. Now, Robinhood is set up in such a way that you could do it daily, weekly, monthly, whatever the case is. For me, I like weekly. So I'll choose the weekly option to invest into this particular asset. So let's say if you set it up on the weekend, let's say you set it up on a Saturday or a Sunday, then automatically for that particular asset, it's going to take out whatever money you decide to invest on a regular basis. So let's say you decide every week you want to put $20 into Microsoft. You'd go ahead, type in MSFT, scroll down, select the option for investing in intervals, and then put the dollar amount of $10. Set it for the weekly. So every week, because you're setting it up on a Saturday or a Sunday, it's automatically every week on a Monday, it's automatically going to come out of your account. And this to me is, yes, you're not putting a large amount in, but this is probably the most effective way of doing it because you're constantly buying into the asset. And just like it says here on the left, overall, you'll eventually have an average price, which is much lower than, say, the current price because you're purchasing in at regular intervals. So I would use the first method, and I do. And I also use the second method, which is to buy in at regular intervals. You have to remember, guys, most people automate their bills, right? Your car insurance is probably automatically coming out of your account or being taken off a credit card. It's the same thing with probably like your light and, your whatever utilities, your car payment, all of those things automatically come out. Well, that's paying the bill collectors. What you also want to do is make sure that you pay yourself. So setting up regular intervals for investing is actually paying yourself. You want to treat this like it's a bill and set it up so every time you get paid, it comes out at a specific time of the week, every week. And over time, you realize the snowballing effect. I could get into compounding interest and all that other stuff, but this is not that video. We'll do another video on that later on. All right, but definitely go ahead and set up regular intervals. To me, it is one of the most effective ways to get into a stock and getting at a good average cost. All right, now the third and final method is to buy the dip. Buying the dip is by far going to be the most powerful way to get in because remember, these are companies that you're investing in on a regular basis. So you bought in a large amount, you do regular intervals, and you also now you're buying the dip. Now, the easiest way to buy the dip is to monitor the stock and then realize when the stock is down and buy into the stock at that point. So for me, I have a particular list that I have set up and it's called my DCA list. And what I do is in this list, I put all the stocks that I own. And then I also put the dollar value that the stock is up or down, as well as the percentage that the stock is up and down. I plan to also incorporate a pie chart in it, but I want to do that in a video where I'll actually show you guys how to create the actual dollar cost average list yourself. So all it is, I just set up all the stocks that I own, and then let's say, there's an overall red day in the market. What I'll do is I'll go ahead and go through my list. As you can see right now, it's up on the screen, and I'll look for the stocks that have the highest percentage change. So if we're looking at this list right now, we could see that in terms of percentage, at this point, XPEV is down 3.62%. So I would consider investing into XPEV at this point. This is just looking at the list at a glance. But when you do this, you're actually getting in at even a better price than when you're buying in at regular intervals. So then some people will say, oh, so why don't you just only buy the dip? No, you want to use all three strategies. Using all three strategies is like investing on steroids because, like I said to you before, buying in at a large amount is just going to catapult your investment way ahead because you're getting a large portion of the stock. You're locking that price in at that point in time. And then as time goes on, the stock is only going to trend upwards. So that's very effective. So you definitely want to do that. And that's something that I do. 2, you want to buy in at regular intervals because with this, you're paying yourself and you're constantly getting in at lower levels as the stock continues to rise. And the third and final strategy, buying in on the dip, it is the most powerful one because you are getting the stocks at a deep discount. Hence, your profits and your overall average will go lower and your profits in terms of gains will be a lot bigger. The problem with buying the dip is you don't want to wait until it gets to that level. So the first one, number one, you want to go ahead and do that whenever you get any kind of windfall or extra cash or, whatever it is from your side hustle, put that in. Then you also want to go ahead and automatically, let's say you work a job and you get paid, set it up so that it takes money out every week or every day or every month, whatever you could manage. And then the last one, like I said, use a tool like the DCA tool that I am going to show you guys how to create it. And you will use this tool to actually buy in and get deep discounts. All right. And that's it for the video today, guys. I hope you found this information useful. If you did, please consider subscribing. I make new videos like this every day. Now, towards the end, you will see a couple of videos pop up on the screen. Please go ahead and click one of those videos and watch another one. I try to provide information that actually has value when it comes to the stock market. All right. Go ahead and also like this video, but more importantly, please share this video with a family member or a friend. Thanks again for watching the video. I really do appreciate it. Y'all stay safe and have a blessed day. Peace.